Okay, we're going to get started. Good afternoon, everyone. My name is Ghazal Marid Momen, and I'm the Outreach and Engagement Specialist with the AVIN team, Autonomous Vehicle Innovation Network. I have the pleasure of welcoming you to the third webinar of the webinar series with BLG. This webinar is part of our Raising Financing During Turbulent Times series and will highlight opportunities for debt financing for innovation companies. We're more specifically going to delve deep into how tech companies can leverage venture and growth debt in conjunction with financial institutions and look at some of the success factors in navigating debt funding. This is a series that we started in partnership with BLG Law Firm back in summertime to support companies as they navigated through some of the challenges resulting from the pandemic. To provide you more context on AVIN, AVIN is an initiative by the Government of Ontario, led and managed by Ontario Centre of Innovation, OCI, to support automotive technology and smart mobility innovation. We support the province in bridging the gap between technology and policy to reinforce Ontario's position as a North American leader in automotive transportation technology and infrastructure system. In addition to raising awareness on public education and thought leadership and bringing major key players together, we also have programs to drive the commercialization of cutting-edge automotive technologies and drive Ontario's push for the adoption and deployment of these technologies across the province and also across our regions. Without further ado, I will pass it on to Manoj Pandit from BLG Law Firm, who will introduce our incredible panel of experts and get the conversation started. To you, Manoj.
Well, thanks, Ghazal. First of all, I should say that it's a pleasure to work with AVIN as usual to bring this roundtable virtual conversation to the audience. AVIN's been a great partner. I can't say enough good things. They are the repository of market intel and network and just overall clearly the leading hub, if not the only real hub for CAV tech companies. So thank you, Ghazal. Really appreciate the opportunity. Just to introduce myself, I'm a corporate partner in the Toronto office of Borden Ladner Gervais. I and a number of my colleagues and partners advise and act as trusted advisors to founder-led companies in the CAV space. And it's been very interesting to see the rise of these companies over the last couple of years. Many come from the southwestern Ontario region, which obviously not only houses a number of automakers and auto parts companies, but now, of course, these really innovative companies that boast world-class talent amongst their ranks. Here at BLG, we do have the leading practice in connected and autonomous vehicle technology space. Our CAV group, includes leading practitioners from a number of practice groups, including corporate finance, venture capital, transportation regulatory, insurance, intellectual property, and employment law. And we also have a dedicated group called Startup and Grow, which assists founder-led companies to get off the ground. So before getting started with, with our dialogue with our panelists, I wanted to take a very, very, brief moment just to quickly make a few observations about our market and the factors that are, converging to produce one of the most important hubs for connected and autonomous vehicles. Clearly, we have one of the highest concentrations of companies. Some people estimate between 200 and 300 companies dedicated to teaching cars to think, from AV technology, artificial intelligence and connectivity, cybersecurity, quantum computing, and the list goes on. There's a long list of players, but just some that come to mind are General Motors, which has 1,000 engineers at its technical center in Markham, Ontario, who are dedicated to research and development in the CAV and related technologies. Ford's $1.2 billion investment in the Canadian market, of course, includes its notable Ottawa Research and Engineering Center that focuses on advancing automotive and smart mobility technologies. The Waterloo Center for Automotive Research, WATCAR, which has 7 research teams that focus on the automotive and mobility sector. of course, everybody knows about BlackBerry's QNX software that's embedded in, like, I don't know what the count is now. Oh, it's certainly over 175 million cars on the road. And the company provides a broad portfolio of security and software for CAVs. So we have industry, we have academia, we have brain power in this region, and it's heartening to see that these factors are converging. One other factor, of course, is the availability of capital. And I just wanted to make one further observation about what's happened in the last year. Canadian venture investment in 2019 was, I think, over $6 billion. But now, when you look at the numbers for 2020, these are based on reporting from CVCA. $4.5 billion of venture investments were made across 510 deals. Notably, in the second quarter of 2020, we saw 1.7 billion of VC investment. I don't need to remind anyone that's when businesses were starting to feel the severe pain of the onslaught of the pandemic. So 2020 saw the second highest level of annual VC investment, second only to 2019, which was really an outlier of sorts, because that year we saw a record, a number of mega deals with total VC investment that year of 6.2 billion. So, but that's an outlier. The 2020 numbers for VC investment represents a 21% increase over 2018, in which we saw only 3.7 billion invested. And some of the notable transactions include, Vancouver-based Chinook Therapeutics, $140 million pre-IPO round, Kitchener's Applyboard's $70 million Series C extension, Calgary-based Adabotics, $66 million Series C round, and of course the list goes on. So if those deals are a barometer of the overall trending, it seems that VC investment focused on doubling down on their rising stars in their portfolios. And the pandemic, it's difficult to sort of ascertain what the tangible impacts were on venture capital investment. But some of our panelists who are more on the lender side with regards to tech companies might have some observations. Anyhow, without any further delay, let's dive into the conversation. We've got a stellar panel. What I'd like to do is to ask each of the panelists to take a couple of minutes to introduce themselves and talk about their organization. So let's start with Amy Ola from CIBC Innovation Banking.
Thanks, Manoj. This is great, and thank you to BLG for having me attend this conversation. It's great to be here. So I'm a member of the innovation banking team at CIBC, and what we do is provide debt capital across Canada and the United States to technology companies. We have offices across Canada, that would be in our head office in Toronto, Montreal, and Vancouver, and then various offices would be Austin, DC, Denver, the Valley, and a newly coined office in New York. And what we are hoping to do is bring debt capital kind of more to the masses for young and growth services. We also offer private wealth management services and tax advice to the management of all of our companies. And we do also offer capital call lines to investors. But our primary offering would be term loans, monthly recurring revenue lines of credit, venture debt, and acquisition facilities. And my main goal would be to ultimately lower the cost of capital and protect an entrepreneur's ownership in the business. But that's kind of us in a nutshell.
That's great, Amy. I thought I was going to hear you say something about Wellington. You've got a long history, at Wellington, and of course now that has been folded into CIBC Innovation Banking. So it's
yeah, I guess
yeah.
it is worth mentioning that, you know, it was about 18 years at Wellington Financial before CIBC actually bought our group in January of 2018. They did have a small group that was kind of lending to the sector, but I think they just wanted to expedite that and wanted to put a group in place that could have a wider offering.
Perfect. Excellent. Thanks for that, Amy. Let's hear Duncan Robinson. You're with BDC. You look young, but I know you've got tons and tons of experience in tech finance. Tell us a little bit about yourself and BDC.
Thanks, Manoj, and I'll take that as a compliment that I look young. So thank you for including me on the panel, and thank you everyone who's tuning in today. I'm looking forward to the discussion with my colleagues on the panel, and hopefully we can provide some good insight to people who are tuning in. As Manoj mentioned, I work for the Business Development Bank of Canada, specifically within a group that provides non-dilutive, highly flexible growth capital to technology companies. So as our organization, we have national coverage. We have offices in all major city centers. Personally, I cover Southwestern Ontario. When you look at BDC, we look to invest across the life cycle of tech companies. Where BDC fits in, and as an organization, we look to fill financing gaps in the marketplace. So we look to participate fairly early in a company's life cycle, earlier than most institutions, I would say. When I say early, we're typically at the post-commercialization stage. So a company has developed their product, they're generating meaningful, repeatable revenue. They have a pipeline that points to future growth in the future, and a defined management team. So like I said, I'm looking forward to the discussion today. If anyone has any questions or comments that we're unable to capture today, I encourage you to reach out to me on LinkedIn or send me an email. Happy to have a conversation after the fact.
Thanks, Duncan. That's great. And finally, Randy Garg, who's with Vistara, and I should say he's not just with Vistara, he is the founder of Vistara and the CEO. Randy, you'll tell us a little bit about yourself, but I know that you've got experience in both equity and debt. So you see both sides of those financings. Tell us a little bit about yourself and Vistara.
Thanks, Manoj. I guess when you're in your fourth decade of investing, you don't get the "you look young" comment anymore. Take that personally.
I didn't get it either. So there you go.
Like I said, I'll take it as a compliment for sure.
Yeah, no, thanks for having me here. So at Vistara, Vistara is actually a Sanskrit word for expansion, which is really what we're all about. So we look to invest across the capital structure. We do growth debt, we do growth equity, or anything in between. We work with companies typically doing 10 to 100 million in revenue, and we're writing check sizes in the $5 to $25 million zone per company. So, you know, really we were born out of similar principles where we're looking to fill gaps in the market in terms of debt or equity, looking to help limit dilution for founders. We work very closely with founder-backed companies. We don't need a venture sponsor in a deal. So if you look across our portfolio, which is across North America, half our companies are where the founders still own majority control of the business, and the other half are where you've got the alphabet soup of venture capital, as they call it, with the series A, B, C, D, whatever's going on. So yeah, we kind of make it up as we go along. We're a 10-person team currently, most of us in Vancouver, a couple of people in Toronto, and we're looking to find great companies to invest in.
Excellent. Well, I'm sure there's a few or many, hopefully, in our audience. So thanks for that, Randy, and thanks for all of you for those introductions. So let's move on to the first sort of topic, if you will. You know, things are changing in terms of the pandemic. Hopefully, all for the good and the better. Hopefully, better times are ahead of us. Without getting too ecstatic about what's around the corner, I think, you know, companies are carefully assessing, you know, with vaccinations coming and you know, herd immunity and all those things, I wanted to get a sense from each of you, as to what you think the transition plan is going to be, given your observations, firstly, I should say, of how the pandemic has affected the companies that you've funded, or perhaps that you've chosen not to fund. And what was that like last year, and recently this year, and then going into sort of a transition where people will hopefully be back to work in the next couple of quarters. What do you see as the impact of that transaction on your ability to provide financing as funders? So, again, it's a conversation, so take it away, but maybe Randy, you can give us your thoughts to start the conversation.
Sure. I guess across the types of companies that we would work with, a bit of a mixed bag. First of all, everyone saved a ton of money on travel and entertainment, and in some cases office space, because their leases came up and they just didn't bother renewing. They also got the government support programs on both sides of the border, so that helped with cash flow. But
although a big chunk went to Uber Eats, I think.
Yeah, so PPP programs or Canadian programs, whatever it was. I think from a company standpoint, what we did see is just an acceleration of various use cases of technology. We were able to close a few deals during the pandemic. These were companies we met kind of either prior to the lockdown or soon into the lockdown, and looking at areas where some of the shifts that are going to be happening over the next 10 years just dramatically accelerated. So, a couple of real life examples: a conversational AI company, that's providing, an AI platform to support call centers. So they've got a number of major banks as customers. So nobody could go into the call centers. So all of this was moving towards automation anyways, but this just accelerated that. Another company in the networking space that does observability for companies like Zoom and Twitch and all these other Roblox and everything else that everyone's sitting around doing at home. Those businesses did extremely well during the pandemic. So, a lot of them we kind of avoided because the businesses were maybe a little shakier or the use case wasn't as strong over the longer term. But in several cases, we actually saw an acceleration in the businesses.
Great.
I'll echo that. And I think, that acceleration in some cases has kind of moved the needle, like even 5 to sometimes 10 years ahead, particularly for software companies that have digitized a particular service that meets this kind of pandemic need, whether that be collaboration, or I'm looking at a company right now that is more desktop as a service, because they have a lot of these companies have their entire workforce working from home. So they're trying to make it as easy as possible and as seamless as possible for new hires and people that are turning out. And Manoj, you asked about the transition plan for us. And I think what we tried to do at the beginning of the pandemic is figure out how to extend capital for software companies, kind of look at the state that we're in and figure out, okay, where will they be in about 6 to 9 months? And then if we layer on another 12 to 18 months of capital with them, sometimes in tandem with an equity round, does this push them out of the kind of pandemic cycle where they could raise and get a healthier valuation otherwise? And so that kind of continues. And of course, we're getting more and more confident with the market as the vaccine kind of rolls out.
Great.
And just to add some, just to add some comments there, I'd echo everything that Randy and Amy alluded to earlier. So I think if you look back at the pandemic, at the start, there was a lot of uncertainty. So we saw a lot of our companies that if they're an EBITDA negative company, their focus was extending the runway. So potentially looking at reducing their growth spending. However, as the pandemic progressed, we saw that mindset shift, and with software companies and technology companies in general, they were very resilient during COVID, and some of them even experiencing some growth. So we saw that mindset shift to investing for growth in the future. And BDC similarly progressed. So at the start of the pandemic, where our focus is on seeing where our portfolio companies were at that particular point in time, being very patient, providing additional capital if required. And now we've progressed to looking at new deal flow for both existing companies as well as prospective companies that we're looking at. That's really the viewpoint that we saw throughout the COVID pandemic.
And so, Duncan, on that point, I mean, so turning the hopeful corner of some kind of new normal, does it change the types of companies that are better positioned for financing, or are you saying, well, we're taking the view that things are going to be back to normal and we'll go back, rewind the clock sort of 12, 18 months or whatever it's going to be, and those are the companies that we expect to fund? Or is there something new that's coming out of the pandemic that we've all learned that is going to help you expand the universe of companies that funders like yourselves are going to focus on?
Yeah, it's a great question. I think our perspective on it is COVID has changed the reality for every single company, irrespective of the type of industry that you're in, or the software that you sell, the product that you sell. So it's really from the lender's mindset. We have to look forward and nobody has a crystal ball, but understand how the COVID pandemic impacted companies. And what the reality may look like in I hate to use this overused phrase, but the new normal. Yeah. So a lot of our initial conversations with company is just around that, understanding the impact, understanding how they dealt with it, and then having conversations around what the future looks like for their company, and ultimately how we can be a part of that in terms of funding their growth.
Yeah, it's interesting because I mean, I've spoken to more than one investor, recently, who've sort of indicated, look, I mean, if there's a founder-led company that had gotten traction, had already launched and gotten traction, and then the pandemic hit, and it impacted their business severely, but now they're, whether they pivoted or not in some fashion, but they've been able to show the resilience of not only being able to survive the pandemic, but actually to maybe even flourish. That's giving us more opportunities to look at, and it'll be interesting to see how many of those companies join the category of companies that all of you are going to focus on in the near term.
I think I can just I'll
sure.
just add Manoj, that because I'm kind of solely focused on technology and this digital adoption kind of just went to new levels. The one area that opened up for me that we maybe had been teetering on was kind of the consumer channels and online channels. So it forced everyone to kind of embrace e-commerce and to move online and to shop online. So in that respect, it kind of opened up this new world of companies to us as well, that we might have otherwise kind of been shy about going towards, because sometimes business to consumer businesses are harder to finance outside of B2B type businesses. So that's been a kind of new shift for us.
Great.
Yeah, I'd agree on the B2C front, a bit more open-mindedness towards that. These companies are scaling, crazy quick. Some of the habits and behaviors I think that we've observed during COVID, everyone's dying to go back to concerts and flying and doing things like that. Myself probably at the front of the list. But I do think that certain things people will think about things a little bit differently going forward. So, as we think about companies, you talk about autonomous vehicles, like, are you going to be more comfortable if there's not a driver in the car? You might actually be more comfortable now for health reasons or something like that, versus previously your definition of safety is now changed. It's more about personal safety. So yeah, there's just different ways of thinking about things. When we look at our companies, can these companies, if we have the next one of these, God forbid, how are they going to manage through that? So software companies, you can have programmers working anywhere in the world, probably less need for in-person collaboration. But other companies, whether it's a hardware company or whatever, where you need people on site doing things, you might want to think a little harder on that. Like how quickly could this company adapt to maybe if something else comes down the corner? So there's just more variables that come into play now as we think about things, but also by the same token, more open-mindedness on different businesses.
Yeah, and that goes for the businesses on this panel, whether it's banks or investors or law firms. I think we're going to be held to that standard as well, and we're seeing it. We're seeing competition, our competitors rather, being able to adapt very, very quickly now to these pandemic type crisis situations, and you got to be able to keep up with your competition. So it goes to both sides of the equation, I think. Let's talk a little bit about the types of debt financing that is available for sort of younger tech companies that are in need of financing, whether it's for scaling up or growth or acquisitions, perhaps bridge financing. But before getting into sort of those very detailed discussions, I guess maybe I could throw this out to you, and I know this is fairly basic, but what are the factors that are relevant? And this is from both the funder side as well as the company side, if you can shed some light on this. What are the factors that are relevant in considering the question of debt versus equity, particularly for founder-led companies?
You want me to start, or Randy?
Sure. Yeah.
Go
ahead, Amy.
I can start,
take it away.
and just Duncan, Randy, inject. So I think kind of the primary things we're all looking at here when we're looking at tech companies is repeatable revenue is often very important. We care about their growth. We care about how much they're burning. So in my particular world, all of my portfolio companies are burning and EBITDA negative. We also kind of zone in on the churn to see what those churn numbers look like. We care about the sector that they're targeting and that they're residing in. I care about their customers. And so kind of like what Randy and I already talked about, like, are they selling business to business? Are they selling business to consumer? Is it small business? Is it large business? All those are a factor. And I care about kind of capital risks around them. So, how much runway do they have right now? And what can we layer on to be effective? And are they going to be able to raise sooner than later? And then also, probably the most two important, we care about their management, and we care about who the team is, and then we care about their IP. And so if I often get asked for this kind of like perfect formula that maybe some traditional commercial lenders do have, because they look at the assets on a balance sheet, and unfortunately that doesn't kind of work for us. And there's no formula. There's all these kind of moving parts to who's kind of ideal in our world. But ultimately, if you're growing a steady pace and you have a good product market fit, and for me, it's very helpful at the earliest stage that you're VC backed, and I'm bridging you to your next round. We'll get involved at doing, let's say, a term loan at a seed stage. If they raise 5 to 7 million of a seed round, I might be able to layer on 1, 2, or 3 million of debt for a growing company.
And I can provide some insight on, it sounds like I might participate a little bit earlier than Randy, and smaller check sizes than Randy. The way that we view it, and if I were to put myself in the entrepreneur's shoes, it's really about timing. When is it right to seek debt financing? And it comes back to my earlier point. What debt financiers are looking for, and Amy touched on it, is really trying to determine if it's post-commercialization. So if they have a product that they've built or software that they built in, it's saleable and they're generating meaningful is an arbitrary word, but meaningful, repeatable revenue with a diverse set of customers. So a lot of the points or indicators that Amy touched on is really just the quality of revenue and the unit economics. So those are very important to us, is breaking down, even if the company is generating negative EBITDA, are the unit economics positive? So the incremental customer that they're bringing on, is it generative to the overall business model? So if I were to think inversely, when it makes sense to potentially skew or index more towards equity, it's really when the business is in its more formative stages. So they're developing their product. They don't necessarily have product market fit quite yet. They're not fully commercialized. Maybe they have 1 or 2 customers. That's more of an opportunity for an equity investor. And then once you have those, once you have the ability to look forward and have some predictability in what the revenue may be 12 or 18 months down the road, I think it starts making sense to have those conversations with, you know, the senior lenders like Amy and junior debt like Randy and myself. Just one point I would add to my comments is, irrespective of the stage the company is in, and I'm sure I can speak for everyone else on the panel, it's important to have those conversations early. So even if you're not quite at that debt stage, the earlier you start having conversations with your banks or your capital providers, the more context that we'll have, and we'll be able to see the progression of the company, even from the earliest stages to where they are, where it starts making sense to have those debt conversations. That gives us a lot of background and context, and it makes our job a lot easier when we're assessing our ability to lend.
What I find quite interesting from the time I started doing this is there are now debt lenders, equity lenders that fill every single slot out there. You could have 10 people on this panel if you wanted to cover every single, like there are people that will lend against sort of early revenue, pre-revenue even companies. So you got shred lenders, you've got people that'll, you know, factor your receivables, people that'll do all kinds of different things, you know, beyond all the stuff that we do. So I guess at the end of the day, it's really, you know, behooves the founders to go and figure out what all the options are out there. You know, depending on what stage you're at. I think the market bifurcates between whether you're a recurring revenue SaaS business or a non-recurring type business, a hardware type business. And then the market further bifurcates whether you're venture backed or you're not venture backed. You know, that'll separate different types of lenders. But then in terms of what stage you're at, there are people that will do almost anything these days. So, you know, I think you really do your homework and figure out what your options are. And if you're, you know, the one risk of that is we find founders try to over optimize and try to get sort of the best deal possible and minimize the dilution as much as possible. And just, you know, they seem to be running the business more as a finance exercise versus a business exercise. So that is the risk with all the different options out there. But there's a lot of different alternatives if people want to do the research.
Yeah, it's interesting because we've also seen the rise of sort of private investors being offered, you know, these convertible note structures, you know, which can serve the purpose. Of course, founders have to be aware of the cost of capital. I suppose they have to be aware of the cost of capital in any scenario, in any type of debt or equity financing. But we've seen a few of those deals as well. So you're right. There's quite a range of different types of instruments. So let's get into that. Like what, you know, I think we've got pretty good coverage. If you say there's 10, you know, there could be 10. We've got 3 of the 10, and the 3 of the 10 that I'm talking to now probably can share the wisdom of all 10. So here we go. Like, what are the different types of debt financing structures? I know that you know you all have your you know unique approaches, but you know just to kind of give the audience a fuller coverage of what is available to a tech company. You know, there's senior debt, junior debt, et cetera. Can you kind of speak to that so that the audience understands what's available for them?
I can have a go, maybe.
Sure.
So you know, in our world, we tend to pick up where the banks leave off, right? So we partner with CIBC, we partner with a number of banks. So you've got your, you know, your senior bank lines, your MRR lines, which Amy can talk further about. So we would tend to come in on a subordinated basis. So the bank security would rank ahead of ours. They would lend up to X amount. We would then do kind of another X or 2X or whatever that right number is for us. We're a big believer in non-amortizing debt. So for companies, early stage companies that are reinvesting in their business, you know, we will do 3, 4, 5 year non-amortizing loans. We jokingly call that rental equity around here. So companies don't have to sit there and plan for paying back the principal. They can actually put the money to work. And then for us, we look to get, you know, repaid through an equity event, an exit event. At some point, the cash flows get to a point where the bank's willing to give more money to the company, so we get our exit that way. We will look for some upside as part of that, usually as warrants. We also do convertible debt, so it's sort of similar to the SAFE concept that you'd mentioned earlier, Manoj, where we go in as debt initially, but then we intend to convert that into equity along the way as part of a round. Standby lines, you know, so not all the capital is drawn up front, acquisition lines, so companies that are looking to do acquisitions. So again, there's unlimited different flavors of this thing if you really want to get into it.
Amy, do you want to address that and maybe let the audience know what MRR stands for as well?
So monthly recurring revenue. We do sometimes look at traditional sources as well, like using accounts receivable for doing revolving lines of credit. But for the most part, we're looking at MRR and a multiple of MRR. And you know, it's funny because there's so much movement in that multiplier right now. It's hard to say like specifically where I land and where Randy takes over or BDC kind of takes over, because we work with all of them. But I think it's safe to say, like, if you're doing an MRR line, you could probably get something that's 3, 4, maybe even 6 times MRR as your access to capital. And then for a term loan, that might go up to 12 times MRR. And depending on the size of the company, we might stretch there, but the likelihood of Randy stretching even further into kind of pure venture debt land is highly likely. And that's kind of how we all talk. And like, I can't say for certain that you're going to get a term loan that's 12 times MRR or 1 times annual recurring AR. I don't want to confuse it with accounts receivable. But that's often like a good benchmark for a bank, that anywhere up to 12 times MRR makes sense, specifically for younger companies. As you get into more the growth stage, which would be, you know, maybe 5 million in ARR, 10 million in ARR and up, that might push out a bit. But it's worth saying too that our term loans, we can do maybe 24 months of interest only, where Randy would do more 4 to 5 months, years. 1 to 2 years of interest only, where Randy would do 4 to 5 years of interest only on a term loan. So you can see like how you can use both as really great tools to extend your runway and ultimately reduce your dilution for the business. And then it's safe to say that it works the same with Duncan and BDC. We've had a lot, particularly this year, a lot of cases where we would do a certain amount of MRR, a small term loan, and BDC also came in with a term loan themselves.
And then you look to blend that cost of capital, right? So the bank's always cheaper than what we can do or what Duncan can do. So for entrepreneurs, like, look at the whole thing and then blend that cost of capital. And we usually try to align covenants and things like that where we have covenant. Yep. So it's just kind of one set of rules that the company has to operate under.
And I guess a way to think about it for the audience is, you know, I always would explain it as if you were going to raise 10 million of equity, Why, if you know you could layer on 3 million of debt, why not raise 7 million of equity and 3 million of debt? And the catch there is the warrant coverage that, you know, Randy or I would ask for is, you know, half the cost of that 3 million in equity. And so if a founder gets really good at this, and which is why you do see, you know, once a founder or entrepreneur kind of goes through the whole life cycle of a business and exits, they can see the value more so in the debt that they were using. So we tend to get a lot of serial entrepreneurs really understanding how to use debt, and they'll do it in every single round that they do, just to hold on to that ownership level, and keep a larger snack bracket for them down the road. It's a really useful tool for management to use.
I don't think I can emphasize the non-dilutive nature, or the debt being less dilutive than equity, even more than Amy, and I think Randy touched on it, is the non-amortizing debt facilities and debt facilities where the junior debt, the return is back-end loaded. It allows the company to simulate some of the patience of equity while having the non-dilutive features of debt. So when you look at structuring growth capital, as Amy mentioned, I think there's usually a place where you can augment your equity raise with debt, and a combination of senior and junior that will allow companies to optimize for not diluting their existing shareholders' ownership interests.
So interesting, because I think from a founder's perspective, you know, you want to look at also the mix of debt and equity, right? Because I think each of you would say, well, yeah, we love this business and we're prepared to lend and invest and so on and so forth, but you know, we need to see some equity come in. I don't know. I assume maybe you can speak to that. I mean, certainly, you know, many of your documents will have debt equity ratio covenants and conditions, but also from the founder's perspective, if they're planning, whether it's an IPO or an exit down the road, they're looking at the valuation and saying, well, in our sector, our valuations derive from EBITDA or income or earnings, right? Whereas other sectors are more about growth and maybe top line revenue. So how do you reconcile that? Like, how do you, I mean, again, maybe the answer lies in the question, but what are your thoughts on that?
So I'd say there's two aspects to that. So for us, you know, we never want to be equity masquerading as debt, right? So we don't want to be taking on that massive burn rate risk, which is really an equity risk, and we don't get paid enough to take on equity risk. So so that's one aspect of it. The other thing is, another interesting thing that we're seeing is companies that are using debt to avoid the whole pricing issue. So we're not pricing the equity when we come into deals typically, or at all really. So if a company is between rounds of financing, they're looking to extend runway, they want to avoid the whole pricing thing. We also have companies that have done a bunch of rounds of financing and they haven't quite lived up to the last valuation they got. So they need to catch up to that. It's another way, creative way to use debt to help them catch up to the valuation. Or you've got pre-IPO situations or pre-exit situations. You're about to enter a process. It's going to be another 12 months or whatever. The last thing you want to do is set price, because the last price that you set is often used as a benchmark in any of those processes. So, so there's different ways that debt can get used creatively to solve for a bunch of different use cases. But for us, really, it's, you know, where does the debt risk stop and where does the equity risk start? Is that line? And it's not, you know, there's art to this. It's not all science.
And just to comment, move even more down market for companies that are a little bit more formative, that they just reach post commercialization. They're starting to get to a point where it makes sense to layer on non-amortizing term debt. However, they're not quite at the venture capital stage, or they're not having those equity conversations. We still look for a portion of the capital structure to be equity, and it comes down to alignment of interests between the debt provider and the equity provider. So there's no magic formula on you know, the proportion debt to equity, but certainly in these earlier conversations with founders, it's important that that there's equity invested in the balance sheet, there's an alignment of interest, and the whole balance sheet's not being funded by non-amortizing patient debt.
Interesting. Okay, that's helpful. Thank you. And just focusing a little bit more on the risk word. I mean, what are the risks that founders need to take into consideration? I mean, of course, at the end of if it's a term loan, at the end of the term loan, you better have enough capital plan to pay back the loan and that sort of thing. But are there other risks that they should be considering along the way? Of course, cash flow and being able to meet the interest charge and that kind of stuff, beyond what we've already discussed.
Want me to take it? Okay, so risks along the way. So the biggest risk is, and just to remind the audience, most of these companies are burning cash. They're not making cash.
That's right.
And so the biggest risk is not finding the capital that you need down the road. And so understanding your covenants that you have in place, which are often liquidity and or growth covenants, and making sure you meet them. And if you miss them and you're not hitting your liquidity covenant, let's say, like a popular for liquidity covenant for me would be that I want to see that you have 4 months of EBITDA burn in cash. Like I want to know that there's time there before you run out of cash completely. And then what that kind of does is align my group with management and them knowing when they should be raising. So hopefully you're going to be thinking about that, 6 to 9 months prior, and getting it all in order that you're going to be able to raise before you trip that covenant, because you don't want to trip it. We'll work with you during that time, but that is the risk of debt, that there are covenants in place that you have to manage.
Right.
Yeah, I think I'd suggest the same, like liquidity covenant, 3 to 4 months of burn rate, some growth-oriented covenants around revenue. We typically don't get into situations where it's sort of, thou must raise X amount of equity by a certain date. That probably means we're not looking at the right type of company. So it's too early for us. So I think those are important ones. The other thing I'd mention is, we tend to, and different capital providers take different approaches, but we tend to be observers on the boards of these companies. So we're in the room, we're in the dialogue, we're helping these companies with their growth plans and strategies. So we're not doing our job if we're going to get surprised by something. We're getting monthly reporting. So it's sort of, in some cases with earlier companies, it's that training wheels that they need to get ready for venture capital and get ready for institutional capital. But if we do our jobs properly, we shouldn't be surprised by things along the way.
Randy makes a good point, and that is for folks taking our debt capital, it's definitely more of a partnership than you would get with a traditional lending platform. There's, I talk to almost all of my founders. Well, we're texting each other, we're emailing each other very often, and I think that's fairly unique compared to like a normal bank relationship you would have. And again, that's because everyone's burning, but they're also our entrepreneurs are looking to leverage our contacts. So we have broad contacts to the VC ecosystem kind of across North America, and we'll make sure, kind of like Randy says, to get you to be partner with you and to make sure you have the introductions that are necessary and to make sure you're getting your capital all lined up for your next raise. I think I've had a couple younger companies, so earlier stage that maybe Randy would get involved, just kind of, oh wow, we didn't expect this kind of white glove service, but it's kind of necessary when you're burning that kind of money. We want a tighter relationship than they're used to with their banker.
And just one more comment on potential risks or something that the participants on the line should be mindful of is just the strings attached with the debt, or what performance milestones need to be hit in order to actually access the capital. So oftentimes there's a fine line between what's authorized and presented in a letter of offer to an entrepreneur or a company versus what actually needs to occur before they can have access to that capital. And that is often hitting specific performance milestones. So just having that conversation with your bank and making sure those performance milestones align with ultimately what the expectations or the financial models that the company is presenting.
Excellent. That's very helpful. So moving on to the next sort of topic, and we've covered some of this already, but if you were to be approached, as you often are, I'm sure, for advice from founder-led companies, how to go about, and we're in a sort of transition phase, as we've discussed, in terms of getting back to some kind of normal in the next little while. But what are some words of advice or wisdom that you can share, anything strategic, with our audience? Some of the audience, I think, is are more mature companies that would be a good fit for some or all of you on the panel, and others might be more early stage. But in the planning for the more early stage companies, what should they be planning for? Is there any advice you can share with them moving in, beyond commercialization and looking for capital? Like what should they be planning for, and what advice can you give them?
Are you talking more about like a bootstrapped company and they're trying to kind of balance? Yeah,
that's right.
So if you can be bootstrapped, the longer it takes you to raise, the better it is, obviously, for you, because you're not giving up parts of your company. But I think there's also, I talk to a lot that I feel they have, if you have cash constraints that are preventing you from, like, say, hiring the best people in the field, that might be a reason to consider venture capital and going out and doing a raise. Or if you're selling to organizations, so like a lot of B2B young growing companies that are selling to large enterprises, those large enterprises, they get that those are startups. And they want to know that they have a solid balance sheet and investors, so that they're going to be here in the next 2 to 3 years. They're going to run. They're going to want to see that you have cash to cover your burn over the next little while. That might be something that kind of triggers you to also raise, and not to be frightened of eventually raising venture capital, because it could extremely accelerate your growth. And so that's the trade-off for your equity. You could grow a business kind of slow and steady, and some do it great at a very fast pace, but some, it takes a lot longer than if you had the venture capital you needed to kind of accelerate. And then my last thing, and then layer on debt. When you're comfortable and have comfort around your forecasts, layer on some debt so that you can have a less dilutive product in the mix.
Right.
I guess I'll take your question from a little bit of a different perspective, because I think Amy did a good job to giving advice on how to capitalize a company. I'll take your question from the perspective of giving advice before you approach a bank or before you approach an equity investor. And it's just providing quality information. So earlier in the conversation, Amy mentioned the things that the qualitative and quantitative aspects that we'll look for. So understanding your KPIs, understanding your burn rate, providing a robust financial forecast that accurately articulates the direction of the company, and then also giving a good slide deck, which gives a good overview of who the company is, the industry that they participate in, the competitive advantages of the company, the competitors that they ultimately come up against in the marketplace, and the strategic direction moving forward. So the more robust of a package that a company has that they're presenting to their debt providers or equity providers, the better for us. And ultimately that leads the subsequent conversations to being more robust, as opposed to asking more of the table stake questions like, what's your churn rate? What's your customer acquisition cost? It leaves for more insightful questions that we're able to ask in those initial meetings.
Great, Randy.
Yeah, I guess I'll go with sort of old guy comment here. There's so much money out there right now. Like there really is a crazy amount of capital looking for good companies to invest in. So the advice I would give to founders is recognize that, know what your options are, but don't try to over optimize this thing, and don't let it get to your head. Right? You need capital to get, and you need to focus on your business. There's way too many founders that are out there trying to get the absolute best deal, the absolute minimum dilution, the absolute best rate from a bank or from us or Duncan. Like, figure out who you want to partner with so you can focus on your business. Figure out who you want to partner with, somebody that's not going to trip up your business if things go sideways for a few quarters or whatever the case might be. So, there's a lot of capital there, but pick your partner and stick to that. And don't try to get too cute about this. Focus on your
So
business.
it's about relationship. You're talking about
It's more than relationship. Everyone's got relationships, but it's really, don't try to, there's way too many, and it's interesting. It's actually, being out west, we notice it, because we're not in some of the centers. We have an office in Toronto as well, but there's certain behavior patterns in certain centers that we find quite interesting. I won't name names or name centers, but different companies and founders in different geographies maybe do things a bit differently.
Cool. Well, I just heard some kind of a bell go off in my ear, and I'm hoping I'm not hearing things. I think that's to signify we're at the end, and I must apologize. I didn't structure this properly, and we were supposed to have Q&A, but look, I think everybody's accessible. They're easily you can find them, all our panelists, and email them, call them to the extent that there's questions. So Ghazal, I'll turn it over to you. I think that pretty much concludes our discussion.
Yes, Manoj, thank you so much. On behalf of the AVEN team, I just want to thank all of our panelists for sharing their very insightful and valuable information with us. And Manoj, once again, thank you so much for moderating such an amazing panel as always. For our audience, we will be sharing the recording of the audio in our social media and also on our website at avenhub.ca. And also you can access our previous webinars, part 1 and 2, on our website as well. Thank you so much, everyone, for joining. And thank you again to all of our panelists for contributing to this very insightful discussion.
Thank you.
Thanks, everybody.
Have a
good day. Bye-bye.